good afternoon, good morning to you from wherever you're joining us from today to be part of this webinar hosted by the Institute of Certified Chartered Economists, the ICCE, together with our global partners. Today's webinar, which is on environment, social, and governance issues around our world, is in series of events or webinars or conversational platform that the ICCE has initiated that will be coming your way in the next couple of weeks and months. We have a lot of issues that we want to discuss about world economy, and of course, you are also a very integral part of it. We have most of these activities planned in the months of September and October, and they are available on the ICC's website, where you can visit, which is www.charteredeconomist.org, to have access to all these events that we've planned and which are under what we call the New Economic Thinking series, which is global conversations around issues affecting our world, and you too can be part of it. So thank you very much for making the time to join us for today's session, which happens to be the first session in this series of New Economic Thinking webinars that the ICCE, together with our partners, will be hosting or be coming your way with. Before I continue, my name is Paul Frimpong. I am with the ICCE. I'm the Global Head of Strategy and Membership. So anything regarding the ICCE, its membership, you'll be able to reach out to me directly for more information. So once again, thank you for joining us for today's webinar. Now, before I continue, I will just be able to give some few announcements, especially on how today's webinar is structured. So first, I am the host. I'm privileged to have the opportunity to be your host for today's webinar. I will have the chance to briefly, for the benefit of those that are hearing for the first time about the ICCE, I will have the opportunity to share brief information about the ICCE to you and how you can be part of the ICCE. After that, my colleague, who is a global head of partnership, will get the opportunity to say some few words or give some remarks. After him, I will then introduce our moderator for today, who will then also take over and run us through the remaining sessions. Of course, you that have joined us, we are very much interested in getting involved in the conversation that we're going to have here today. So you have the chance to send in questions or comments regarding the topics that we're going to discuss today via the Q&A button. So on your screen, on your Zoom app or web, you will see there's a Q&A button there. That is what you can use to send in any question that you have regarding today's session that we're going to have on ESG. So once again, thank you and welcome to today's webinar hosted by the Institute of Certified together with our global partners. So we are very privileged that at today's session, we have distinguished professionals who are well deep and into the ESG related issues. So today we are discussing what we call integrating ESG in emerging markets from crisis to resilience. Of course, we all know what is happening around the world in terms of the global health pandemic caused by the COVID-19. And so we still have to dig deeper to understand how in all of this, how are we integrating ESG in emerging markets. And emerging markets is the kind of market that constitutes about 80% of the global population and also about 70% of world GDP. So it's a very huge section of the world economy that we want to see how ESG is actually being integrated in this market. So once again, I will take this opportunity to, for the benefit of those that are here with us for the first time in terms of ICCE, I will use the next 2 or 3 minutes to give a brief introduction about the ICCE, who we are, who are our partners, and what do we do, and most especially, how can you be a part of the ICCE. So the ICC simply stands for the Institute of Certified Chartered Economists. I will play this 60-second video, and then I will continue from there.
Each day, we are faced with asking the most difficult questions about life, our society, and the world economy at large. The answers we seek are inextricably linked to the commitments we make and the actions we take. At the Institute of Certified Chartered Economists, ICCE, our commitment is to raise professional economists with the highest ethical standards through quality education and collaborative learning. Our global network of economists professionals are challenging conventional wisdom, advancing ideas, and contributing to the transformational agenda of the world economy. ICCE is raising economists globally, and you too can be one. Make the smart choice and become an ICCE charter holder today. Join the ICCE today and let's measure up. www.charteredeconomists.org.
Yes, so that is a short introductory video about the ICCE. So the ICCE will stand for the Institute of Certified Chartered Economists, is a qualification for today and tomorrow's economists. So we are a professional body which is globally accessible, and the commitment and the vision of the Institute is to raise economics professionals with the highest ethical standard through quality education and collaborative learning. So we are very fortunate to have some astute individuals from all around the world who are part of the ICC as its global leaders. And these individuals makes up what we call the Global Governing Council and then the International Board of Standards. So these are the individuals that are supporting the Institute and providing the guidelines that it needs to be able to deliver on its vision. So we have Dr. Fran Lutier. She is a senior partner in CEO of Southbridge Investment. She is a former World Bank Vice President. She's a former Africa Development Bank Vice President. We have Professor H.K. Pradhan, who is a professor of economics and finance at SLRI, which is one of India's leading business schools. We have Dr. Mustafa Ibn at the University of New Brunswick in Canada. We have Dr. Lalima Mukherjee, who is Associate Professor of Economics, University of Engineering and Management in Calcutta. Dr. M. Azhar Hussain, Associate Professor of Economics, Rosedale University in Denmark. We have Danidi Marcia. She is a Chief Economist with Deutsche Bank, based in Johannesburg in South Africa. We have Dr. Barun Takar, who is Associate Professor of Economics at Flame University, also in India. And then we have myself, as well as my colleague, Gorish Lagu, who is also based in Hyderabad in India. So that is the leadership of the ICC. Now, as a membership-based organization, obviously, we have guidelines and rules that each prospective learner have to go through. So here we say that to be eligible to be applied to be part of the ICC, you need to be at least be admitted to a bachelor's degree or equivalent. So once you're in your first year in your higher institution of learning, you can be part of the ICCE. So we say holders of PhD, MPhil, MBA, MA, MSc, BA, BSc, and all of that, you are all equally qualified to apply to enroll in the ICCE. So here we have three types of membership. So we have what we call the learner. So these are the registered members who are here to complete all the ICCE exams or the curriculum. How the exams are structured and how the curriculum is also structured. And then we have a charter holder. So this is when an individual learner completes all the ICCE curriculum through the examination that we offer. And yes, we have a fellow. So these are distinguished individuals. They do not go through any examination. They are identified and honored because of the contribution they are making to the world economy. Now, to begin, we have some gateways. Obviously, we know that each learner will be coming to the ICC with various backgrounds, academic background, various experiences. So we definitely have some gateways that an individual can use depending on his academic and work experience. So we have what we call professional economist gateway. So here we are saying that if you're an economist or if you're practicing as an economist for the last 10 years, you have a special gateway, and this gateway gives you the opportunity to be exempted from most of the ICC examination. And with you taking just a few steps, you will be awarded as a ICC charter holder. Of course, we have a faculty gateway also for individuals who are faculty members of various institutions who are teaching or heads of department teaching a number of credits in economics. So they also have a gateway to be part of the ICC. And then we have the standard gateway. Here, that is the most common entry route for most applicants, where you start from the beginning, as I'll show in the curriculum structure. So with the ICCE, what we do is that as you register to become a member, you are required to go through a series of examinations. And this examination is basically to standardize all our members, because we understand that members will be joining from different parts of the world with different backgrounds. So we introduce examination that set the standard for all of us. Now with the ICC examination, our mode of examination is through the computer-based testing, and it's accessible remotely. So what it means is that you do not have to move to a particular center to take your ICC exams. With the use of a third-party proxying system, which is an artificial intelligence-induced platform, you will be able to take your ICC exams anywhere you are, whether at home or office, with much convenience. And the ICC exams offered every month from January to December, and you have most of the details available on the examination page on our website. The pass mark for each exam is 50%. Now with the ICC curriculum, so these are the modules that as a learner you go through and complete the examination before you be awarded as an ICC charter holder. So we have 3 levels as well as specialization level. So the first level is investment 1, microeconomics, macroeconomics, financial systems and development. We have the continuation of some of the level 1 papers in level 2, where you take the second part of those papers. We have econometrics, we have corporate finance being introduced, and then we have international trade, international finance, economic and business ethics, as well as the part 2 of the econometrics in the level 2. Now, once you're done with these 3 levels of level 1, level 2, level 3, you have the opportunity to specialize in any of these areas. So here we have what we call financial economists, petroleum economists, energy economists, health economists, managerial economists, marine economists, labor, industrial. So you have the choice to select any of these specialization area and take those 2 papers that this specialization area presents. So that is how the curriculum is structured. So as a learner or as a member of the ICCE, you are required to go through all these modules and take the required examination, get the required pass mark, which is 50%, and thereafter you will be awarded as an ICC charter holder. Of course, there are applicable fees. So here is how the fee structure of the ICCE is. So we have non-refundable registration fee, which is one time at $210. Currently, the institute is running a promotion which gives about 60% discount on the initial enrollment fee. So if you are part of this webinar and you want to be part of the ICCE, you can start with just paying $84 instead of the $210 US. We have an annual subscription fee as a membership organization and typical of all associations. As a member, you are required to renew your membership each year, and this one is set at 59 USD. We have initial re-registration fee, which is that if you default on your annual subscription fee, your account will be suspended, and in order for you to get access to your membership, you have to pay $150 before it will be activated. And the examination fees are also structured according to level. So the initial level, which is level 1, is at 54 USD per paper. And there we have 4 papers, as I showed earlier. In the level 2, it's 63 USD, which is also covering 5 papers, so 63 USD per paper. Level 3 is 72 USD per paper, and the professional gateway is at 89 USD per paper. And of course, we have issues about exemptions as well. So in the event that you have a previous qualification, especially in economics, and you apply to be part of the ICCE, we offer you an opportunity in terms of exemption from some of the papers that you've already taken in your previous studies. And there also there's a fee that apply, which is typically lower than the examination fee. And then finally, we have what we call final certification fees, which is set at $225. So on the average, you will be spending from start to finish between 1,200 to 1,500 USD to get your ICCE certification. We have scholarship opportunities as well, where our learners can tap into. So while I mentioned the fees earlier, you have the chance to win yourself a scholarship. We have the Future Economy Scholarship. This is open to all ICC registered members, irrespective of where you are or your gender. You can apply for this scholarship, where you can get either partial or full scholarship. We have the Women Economists Network Scholarship, which is only available to female learners of the ICCE. So if you're female and you're part of the ICCE, you can also win yourself a scholarship by applying for the Women Economists Network Scholarship. And of course, Media Professional Scholarship. Here we are referring to all media professionals that present on business or reporting on economic issues from around the world. So you want to also better expand on your knowledge and want to be part of the ICCE, we give you the opportunity to do so through the Media Professional Scholarship. And of course, we have faculty scholarship for faculty. One final aspect of the ICC, which is called My ICCE. So once a learner has been on board onto the program, we give them access to our LMS, Learning Management System, called My ICCE. So this is where all member activities happen. So you're registering for an exams, you're paying for your fees, you're checking your results. This is where you take your ICCE examination from. And here you can also have the chance to interact with other learners through the forum discussions. You have questions about something that you're reading, you can share it via this My ICCE, and other learners will get the opportunity to comment on it as well. So if all that I've said, and of course in the course of our discussion, we'll give further information about how you can be part of the ICCE, you can actually visit our website, www.charteredeconomist.org, which is on your screen, and then you can be part or begin your journey to become a professional economist with the ICCE. So thank you very much for granting me the opportunity to share these introductory remarks about the ICCE to you, and we are hoping that in the coming days we will receive your application to be part of the ICCE, and together we will shape conversation around our global economy and to measure up to the standard that is required of an economist. At this point, I will go straight ahead and welcome my colleague, Gorish. Gorish, you are there to give your remarks on as a global head of partnership for the ICC. Gorish Lagu is our global head of partnership. So Gorish, please proceed.
Thank you, Paul, for a wonderful introduction of our institute. I think that covers everything all. Thanks for giving me an opportunity on this very wonderful topic of ESG. ESG is gaining a lot of traction, especially after the pandemic, wherein the investors or the corporations and even some governments or public enterprises are more aware and giving more budget allocation to ESG initiatives or ESG parameters, where initially ESG was more of a very large corporation fundamental. Now even the medium scale corporations or businesses, or even the newer markets, it could be developing markets like some in Asia, are looking into ESG space in a very serious manner, wherein they are hiring ESG professionals, they are hiring ESG experts like the ones we have on our wonderful panel today, and trying to understand how they can contribute to a more sustainable, environmentally better. It could be having a good ESG practices within the organization, or streamlining their supply chain, or doing something for the environment, especially with the climate change becoming a very, very important topic globally nowadays, and we have to be serious about it, because it's hitting us harder than what we are thinking. It's coming in thick and fast. So it was a concept of the developed nations before, but now we have it coming in the emerging markets, wherein the corporations are giving more attention, and even the investors. So because I've also worked on the investment space, I know certain venture capitalists or funds who are, apart from evaluating not only the balance sheet or the financial statements, are also asking the ESG score. So I think the ESG professionals globally are doing a wonderful job, wherein the investors are not only evaluating a particular corporation on a financial parameter or a financial rate of return parameter, but also on this ESG parameter. Also, if you see globally, we have certain boards or bodies like the Sustainable Accounting Standards Board, or the Global Reporting Initiative, where majority of the corporations are part of it, and they cater to various quantitative and qualitative ESG disclosures in their annual reports or their filings. Also, we have something that's called the International Integrated Reporting Council, which is having more parameters than only the financial parameters. So I think that's a very good step, wherein these organizations focus more on the ESG parameters. And I will say with COVID, we have seen that the corporations are the willingness to spend more, as I said earlier. And I see the road ahead for ESG very bright, and it's not only good for us globally, but also it is to make corporations more aware, where they pollute less, or have use more renewable sources of energy. It could be anything wherein we make our planet more sustainable. So I think I'm very excited to hear from the experts Pankaj and Smita on this. I also uh, I am heading the global partnerships for ICCE, and I take this opportunity to welcome any feedback or any partnerships that the current participants are willing for their partners or for their employees who want to come and have a strategic partnership with us on ICCE, or who want to get their staff on the board of ICCE. I will leave my email ID in the chat box. You can reach out to me directly. Thank you, Paul, for your opportunity.
Thank you
I
very
hand
much.
over to the. Thank you.
Thank you very much for the brief intro. As you mentioned, he will be open to any form of partnership opportunities that will come his way. So he will be sending his email address in the chat box to all participants. So if you have any information regarding how you or your organization would like to partner with the ICCE, then Gorish will be the best person to reach out to. And so you can check out his email so that you can send any such information to him. So once again, thank you for Gorish for that remarks. So then we go into the substance of the day, which is to discuss about ESG, integrating ESG in emerging markets. And to help us do this and lead the session or the discussion, we are privileged to have Smita Hari, who is the Vice President, Sustainable Finance and ESG at Octus ESG LLP, an Indian-based ESG consultancy firm. I will give her the opportunity to also touch a bit on her company and what they do. Smita is a finance professional with over 15 years of corporate and entrepreneurial experience. She has an MBA in finance. She has worked across sustainable finance, ESG, impact investing, business strategy, research and implementing investment banking organizations like ING, EY, Marsh & McLean, Spark Capital, and Industry Bank. Smita has also done the entrepreneurial hat in her career, handling assignments on go-to-market strategies and worked on research papers related to impact investing, private equity, and venture capital funding. At Octus ESG, Smita takes care of project implementation, design, and development of financial product, stakeholder management, and business development across sustainable finance, ESG, and climate strategy. So ladies and gentlemen, with much appreciation, we will welcome Smitha Hari, who is our moderator for today's webinar. So Smitha, please take over. Thank you.
Thanks a lot for the introduction, Paul. Can you hear me?
Yes.
Am I audible? Yeah, okay.
Yes, I can hear you.
So thanks, it's a pleasure to be a part of this session. Hello everyone, and welcome to today's webinar on integrating ESG in emerging markets. Thank you for taking the time out and being here today. So before we jump into the topic, just a brief introduction about Octus. So Octus ESG is a global expert advisory firm in the areas of sustainable finance, climate strategy, and ESG. And while we are based in India, our work primarily is across Asian markets, African markets, and some pockets of Europe. And the firm was started last year by ex-CXO of a large Indian private sector bank, Namita Vikas, who has close to 30 years of experience in sustainable finance, ESG, and climate risks. So let's jump into the topic now. So for years, sustainability issues have been a secondary concern for investors. But today, institutional investors and pension funds have grown too large to actually ignore environmental and social impact on their portfolios. So ESG, which involves using environmental, social, governance factors when determining which programs, funds, or companies one must invest in, has become increasingly popular in the past few years. And of course, the onset of the pandemic has only intensified the consideration of ESG factors in business strategy and investing decisions. Worldwide, the adoption of ESG has increased, with around 90% of S&P 500 companies reporting on ESG or climate. The value of global assets applying some degree of ESG data to drive investment decisions has almost doubled over the past 4 years and more than tripled over the past 8 years. And it stands at around $40.5 trillion as of mid-2020. And of course, global interconnectedness would result in a cascading effect across markets, so including emerging economies. But given the increasing pace of climate change and social priorities, is the current level of ESG adoption sufficient? And how does the scene look in emerging economies compared to developed countries? And how much of the ESG related disclosures are actually true? So these are some of the many questions and many aspects we are looking to discuss in today's session. So today we have with us Mr. Pankaj Sharma, co-founder and partner of EM Alpha. I'm extremely pleased to welcome you today, Pankaj. Pankaj, throughout his career of almost 2 decades, he has been focused on analytical rigor and understanding investor preferences. Pankaj has worked with a diverse set of organizations, including leading global investment banks such as UBS, JP Morgan, and Citigroup. Pankaj was ranked the #1 utilities analyst in Asia Money and runner-up in institutional investor polls. He has also received Thomson Reuters Starmine Analyst Award for Best Earnings Estimates and Best Stock Picker. Pankaj is an ESG thought leader. He has a deep understanding of the ESG ecosystem and global ESG frameworks, and his perspective is sought after on ESG and sustainability issues. He has also been an author writing on subjects which are at the intersection of economy, society, politics, and technology, on works commissioned by leading publications such as Bloomsbury, Routledge, Taylor, and Francis. His upcoming book is ESG, Rethinking Business for Sustainable Futures, which is to be published at Routledge in the second half of 2021. Pankaj is the co-founder at EM Alpha, a ESG-focused analytics firm driven by AI, ML-based solutions. EM Alpha has developed a flexible ESG framework management system, a proprietary technology that makes ESG analysis framework agnostic, thus allowing for quick adaptation. It also lets the users decide what matters to them and a classification of evaluation parameters into specific E, S, G, and more granular categories. Welcome, Pankaj, and over to you.
Thank you very much, Smitha. Such a wonderful introduction. Also, thanks so much to all Manish and the entire ICC team. It's been a pleasure. Thank you so much for the opportunity. Very nicely explained by Gaurish and then by Smitha that how emerging markets have also started to see a lot of interest in ESG. And since like my background has been largely in the investment space, This change is profound in the sense that like what you see the situation now on how the investors and the companies are looking at the ESG and sustainability space, and compared to it just maybe 3 years back, there has been a sea change in that. In terms of not just from the point of view of getting better investors and making yourself more attractive to the institutions, but also to identify the blind spots which you have in the organization. So it's like this, that sometimes you look at your strengths and weaknesses, but somebody else who comes on board and probably that person can tell you better what you lack and where you can improve. So ESG has both purpose. One is internal, where you identify what you get, what you need to improve, where you get better, and then also external in terms of how you protect yourself in terms of the initiatives you are taking. So I have prepared a small presentation which I'll share. I think this probably will give you a better idea in terms of what we do and how this is relevant for the emerging markets. So can you see the screen now, which I've shared? Okay, great. So as Smita explained, that EM Alpha stands for Emerging Markets Alpha. We are especially focused on the intricacies which emerging markets have in terms of how the investors would look at them. And the alpha means the excess return which you would generate over benchmarks. So that's the short form, EM Alpha. And what we do is it's a AI-driven emerging markets investment and ESG solution for both public as well as private markets. That's again interesting because private markets, as Korish was also saying in his address, that there were times when the thinking was that just the public companies or the listed entities would have to think about how they project themselves to the outside world. But that is now changed. If you see the way things have changed, even for the private companies and even for the investors, many of the private equity guys we talk to and people, they are very critically evaluating how the portfolio companies are performing on the ESG parameters. And it's not just a particular preference for either E or S or G, but it's a very balanced approach in terms of how they are impacting the environment, how they're looking at the climate, how they are doing the social work in terms of their interaction with the ecosystem and the community, and also the governance, which again is the bedrock of how they will invest and what they will look at. What we do in terms of our approach, the basic problem which we have in emerging markets today is the lack of reliable information in terms of how somebody would evaluate the ESG filters. So, for example, like today we have a massive increase in AUMs. People are getting very, very excited and bullish about the fund flows. And last 3 years, especially post-pandemic in 2020 and 2021, you have seen a very significant increase in inflows in ESG funds. And unfortunately, you have a situation where there is a lot of discrepancy in terms of how the reported data, the official data for companies look like, and how the public data would probably project. And then there is some of these frameworks mentioned by Korish also, that you have SASB, you have UNSDG, you have Global Reporting Initiative, ECFD, which is Task Force on Climate-Related Financial Disclosures, and so many other things. And many times companies, investors be very confused about what to look at, what to refer, and how to go about it. So in terms of what has happened in post-financial crisis, and this got accentuated because of COVID pandemic, the low rates in G10 makes EM attractive for investors, but there are challenges. One is timely information, which is a very cost-intensive and time-intensive process. Then languages, which is a very integral part. So for example, if you look at something which you would notice very early on in the English media or the business news, which are in English, probably may not be that relevant. So if you look at countries like Indonesia, Vietnam, Brazil, Poland, China, Korea, you will have to do a lot of analysis on the basis of what the local news flow contain. And we see a huge discrepancy in the sentiment scores or the ESG scores you would be getting from analysis of English language versus analysis of local language news flow. And also in terms of quantum. So for example, like the ratio is almost 20% to 80%. On a certain company in a country like China, you find just 20% news flow is in English and 80% is in local language. So it would be impossible for an investor to ignore that 80% and then hope that the investment decisions would be right. So that's something which we focus on. And also there are delays at times when the English news would capture something a while later, and by the time it would be a little too late for the investor. How we work, we have both sides in terms of technology as well as the domain expertise. We strongly believe that unless you can balance these two parts, it would really be very difficult to address the ESG problem holistically. Domain experts' role is very, very important because they would understand the issues and their relevance. At the same time, they would be required to explain it to the technology people how the solutions have to be developed, how the platform analytics, all that needs to be developed, and for that you need the technology people as well. So in this case, both AI and domain experts have come together, and this makes the ESG and alpha solutions a little different from what you usually find in the market. Then also the best part about what the platform would do is that you have a flexible ESG framework management system. It means that once you have your data, you can pick and choose which platform or which framework you want to evaluate upon. So let's say if you are more passionate as an investor about the climate change issues, then probably you would look at TCFD. And if you want to look at a more role which UN is playing, the SDGs which you have, the 17 SDGs, and if you want to evaluate your portfolio on that, you can as well. So depending on the investor preferences, you can decide which framework is the most ideal for you, and you can use it. Then users have the flexibility to decide what parameters are more important for them. So for example, this is a very, it's very easy to say that everything is important and you have to have E, S, and G equal weightage. But when it comes to investment decisions, sometimes you have to think about locally what's in favor. So for example, in Europe, if you have EU taxonomy and the requirement for disclosures, which is more focused on environmental issues, you have to respect that. Similarly, if you have to look at many of the emerging markets, the governance issues would be very, very important. So for example, let's say a country like South Korea, you would find that companies are making very decent progress on environment and social issues, but governance is a problem. So in that case, you have to think about how you would look at a geography or a company and then decide that what is more important for your investment decision. And that's where the flexibility part comes in, where you can use your model and apply that on the platform which we have, and then look at how the platform is evaluating the portfolio or a company on different parameters. Then as I said, like there is a lot of technology involved. So you have first multilingual data collection, then machine translation, then attributable ESG dictionaries, which are very specific for framework, then the flexible framework that comes in. In all this, there is a virtuous loop going on, in the sense that things are improving on the base data you are generating, and then you apply and see the results, how they look like. You're not trying to, like, it's a very different approach versus the best fit approach you would take in regression or back test. It's very different. Like what you're doing is that you're trying to improve the process on the basis of this loop, which is a virtuous loop. Currently, what you have data in 3 months later, the inferences and the analysis should get better, should get more correct and appropriate. That's what we do. And then I have explained this about the power of ESG framework, which is flexible. You can look at different frameworks like SASB, TCFD, GRI, PRI, UN SDG, and EU taxonomy. There are a lot of others, local, regional frameworks as well, a country-specific framework as well, and you can decide what you want to use. Then significant time savings in terms of how you evaluate these portfolios and the companies. And then you are trying to, because ESG is a space which is relatively new. Like this is something which has happened in the last 15 years and more so in the last 3 or 5 years. This space has evolved very, very quickly. So you also need to look at what more can be done, what more is possible, and how you can align the investment thought process with the changes that are happening in regulation. So you would see a lot of developments on the side of regulators, you would see a lot of developments on the side of your local authorities, but everything has to come together to make a real world impact that is positive. And this is all about the make impact which has to be real, which has to be significant, and which has to be positive on the world. We'll look at some of the case studies which our data has picked up. So the way it works is like our machines collect the news flow, they analyze them, and then offer very interesting insights. So some of these insights from different parts of the world I have tried to capture, and these are in the following slides. I'll begin with Samsung. I have deliberately not put in a stock price chart for any of these companies because it's like a homework for you, for the participants. If you see companies here and see the stock price chart and try to figure out why the stock has behaved in a certain way and how the ESG has been relevant in that sense, that's something which will be a very nice learning for each one of us. And that is something which is very, very important to make the systems better, to make the process more appropriate for the analysis. So, for example, Samsung, South Korean company, everybody knows about, a market leader in many of the products they make. Great company in terms of product, great company in terms of your technology. But in terms of governance, as I was saying, that things are not at the level which is at a desirable space. So, for example, in January, there was a massive news flow on the chairman of the company, and he was sentenced to more than 2 years of imprisonment by the Seoul High Court on the charges of corruption and bribery. And this is not new. Like there have been regularly incidents with many of these South Korean companies, more so with Samsung and the political nexus they have. Then it got downgraded on ESG ratings twice by the Corporate Governance Service. Then also, what you look at in the case of Samsung is relevant for a lot of other companies in that geography. In last 60 to 70 years, the way Korea has developed, a lot of these large conglomerates, they have played a very important role in the growth, in the economic growth of the country. But at the same time, the political nexus which they would have, that makes governance issues a little tricky. So you would see a very easy comparison to make is that where the peers would be trading in terms of their relative valuation, how the market would be trading at a valuation. And that's something which will tell you that the governance part is not really in a great shape. And this is very strange because many of the global competitors which Samsung has, you look at Apple, you look at even the technology companies from US, they would do far, far better on many of these scores if you divide ESG in 3 different parts. And if you see Samsung, products are great, as I said. Social and environment part is not that big a problem. They're doing well on that, but governance is a big issue. So these are the things which the news flow and the local news would be able to pick up very, very quickly. The next one is the China tech space. I have deliberately not put China's tech space because in the last 3 months or maybe less, since October 2020, you have seen a lot of churn in that space, but especially the edtech because it has a very strong component in terms of the social impact many of these companies would be having. And if you see, it's again, in any emerging market, you would see that edtech would be one of the fastest growing areas. And in this case, many of the events which have happened, especially on the regulation side, haven't been really positive. The Chinese government has imposed strict regulations to disallow the edtech companies, primarily operating with a profit motive. And that just kills the business model. And you would have seen, a lot of people would have noticed the kind of restrictions China is imposing, that how many hours kids can play video games and all that. it means that the social part of your investment is going to play a very important role in how it will perform. And this is relevant across the board. It's not just the case with China. The kind of things you would hear about in case of Baiju's and the impact they would have on social part and the kind of practices which they have in selling and other issues. These are very, very relevant. And I'm not saying that regulation would come in and it will disrupt the business model, but you have to be aware of that. There are possibilities that the social part would lead to so much of backlash that these things would not really look that great. And that's very, very common. Like what happens with social media today, that any of these issues will get magnified very, very quickly, and they will grab attention, and that impacts the investment thesis of a company. And the next one is, it's a big daddy of coal industry in the emerging markets as such. It's the largest coal miner, and it's a government-owned company, Coal India. And the IPO happened almost 12 years ago, but still remains the largest IPO. Because we are waiting for the Life Insurance Corporation IPO in India. But from the perspective of the money which has been raised in one single IPO so far, it remains the largest. But the stock price return since then has been pathetic, very bad the performance. And primary reason is when you look at a stock like Coal India, the impact they are having on environmental the surroundings and what they do with mining. And that's something which is also related to business model. So when we talk about a business model, when we talk about a company fundamentals, you also need to look at how the company operates. In this case, more than 90% of company's production is from open cast mining. And open cast mining is easier, but at the same time pollutes more. And that's something which is very, very important in this case. And if you look at the list of largest emitters, Coal India would be multiple times bigger than what you would see next. Top 10 miners, like combined, would not emit as much as Coal India emits on its own. And that's something which is a very important point. A lot of people would stay away from these kind of companies. And as you see, in Indian markets, you have a situation where the foreign institutions are very important. And that is where they would look at a company and say that, okay, this is polluting so much and I'm not interested. But also there are issues related with the social impact and the governance, because many times the management is questioned on the capex requirement, the growth and the target achievement, etc. But overall, the basic issue with them is related with the environmental. Then you have, again, like private markets, when you talk about sea change in what happened in the case of Flipkart, last 3 to 4 years since the time Walmart took a majority stake, there is a very significant change in terms of how they approach the communication part. And if you see what they have done, they have focused a lot on the social part. And remember, like Walmart in US had a lot of issues in terms of how they are perceived in the social impact. A lot of media backlash, a lot of negative publicity, and they are trying to address that. And it's not a listed company as yet. Of course, IPO might happen 6 months down the line or 1 year down the line. They have been trying to address this problem from the very beginning. Like since the time they acquired this, they have been very actively working on the communication part. They look at that very, very closely and address that. And all that gets picked up by EML, AML models and the machines, or in terms of what's happening in the space and what is getting more prominence. And this is something which is again related with a lot of positive issues like employment creation, support for SMEs, education and learning initiatives, and community development. And the kind of emphasis which they have today on that part, the number of press releases, the issues they talk about, you see a lot of it is related with the social angle. In a company, usually from developed markets, you would not expect too much of a problem in terms of how they would look at the governance, but the social issues are very, very important in these cases. They are trying to address. Then again, a company which is extremely relevant for funding part. So a lot of people talk about in emerging markets that they are big polluters and they are leading to a damage to the climate and responsible for climate change, not that much of a talk happens about the funding part, and that's changing. So when you look at a regulation at, like EU taxonomy or net zero asset manager initiative, a lot of it is now related with what's going on in this space related to funding. A lot of people are questioning that why the funding should continue to something which is as bad as coal, something which is as bad as oil and gas company. And this has been a primary reason what happened in case of ICBC. A couple of months ago, Legal and General, a very prominent asset manager, exited the investments which they had in this company. And that's probably related with the same fact that ICBC has been funding the coal plants, and it's not supporting the initiative which should be taken on the E part. That's again a very interesting example, because what we discussed, a case of coal company which was there, Coal India. Then you have globally, you have listened to a lot of media news and reports about the ExxonMobil case, where a small hedge fund, Engine Number One, which just had 0.02% of ownership, managed to get at least 3 directors appointed into the board of ExxonMobil. So you have on one side companies which are actual polluters, and on the other side companies like ICBC, Industrial and Commercial Bank of China, which are responsible for funding. And this is in the entire BFSI space, you would see that this is not just relevant for banks, it's also relevant for the insurance companies. For example, like TCFD talks a lot about risk which climate change was posed, and also, the risk which climate change would pose, and also the opportunities it offers in terms of transformation, in terms of transition. And insurance companies have to be very sure of what they are doing about this. Are they covering the risk, but at the same time, are they identifying the opportunities and trying to capitalize on that? So that's something which is a very, very relevant portion for BFSI space, funding side, insurance side, and everybody else. Then again, the largest market cap company from India, Reliance Industries Limited. In the AGM which happened in June, very important announcements related with what they are going to do in the green energy space. And immediately you see that a lot of news flow, like almost $10 billion of new investment in the green manufacturing, the green energy initiatives. And you know that this is a company which generates a lot of, almost entirely the cash comes from the oil and gas business and refining business. But for future, for next 10 years, 20 years, they know that things will change, it will evolve. And as you see that today they have another business, which is Reliance Jio. It's not as bad as the oil and gas business would look like, but they're going a step further. They're looking at the green energy in terms of how business would get into areas which are more positive on the ESG parameters. So for example, does this mean that the O2C business, which is oil to chemicals business of Reliance, they need something extra, something else for investor interest? And in today's world, you would see that there is nothing better than ESG in that sense. So it's a great initiative, of course, but very, very good in terms of investor interest, in terms of how you would be portraying yourself as the parameters on ESG and how you would be doing on that. So that's something which is a very relevant area in terms of how the company would be evolving and how the company would be transforming. Then again, company which is in this presentation only because of COVID-19. It's a company which is the largest rubber glove manufacturer in the world, Malaysian company. Did very, very well till October last year because the demand was rising, exports were booming, and stock price went up almost 6 to 7 times. But then something happened on ESG. This is one company where the EML AML machines have picked up a maximum number of news in the Southeast Asian market. Almost, I would say, on average, daily 15 to 20 news related with something or other in that space from November till January. What happened in this case? So, for example, this is a company which uses a lot of outsourced labor, and there were news flow that the condition for these dormitories and the living accommodation was not abiding the COVID protocols, and the conditions were pathetic. There were cases of COVID-19, but they were suppressed, and the company didn't do enough. Then in January, something else happened. BlackRock, which is a very, of course, the largest asset manager in the world, but also very known for the stand they take on the ESG issues. The CEO, Larry Fink, is again a big proponent of how the corporation should behave and how the ESG parameters should be looked at from a company's point of view. And they took a stand that they would not support some of the resolutions which the company wanted to put forward. In the AGM in January 2021, on 6th of January to be more precise, they voted against the re-election of 6 independent directors. And look at the issue here. Executive directors, people would know that they are part of the group which is running the business. But it's also the responsibility of independent directors to raise their voice and talk about issues which are relevant from investors' perspective, from an institutional perspective in the ESG space. At times, it would be possible that executive directors may ignore many of these issues, but the relevance of independent directors and their role is based on what stand they would take on ESG issues. And many of the institutional investors would look at that. You would see a lot of examples everywhere, like remuneration packages which are being proposed, they are getting stalled, investors are not allowing them to go through. And there are many other events which are indicating that ESG would be a very, very important evaluation parameter for independent directors and the performance. Next is a company from Brazil, JBS SA, the largest meat producer and victim of major cyber attack. They had a major problem a couple of months ago, and there were talks of and the reports that they paid a ransom, $11 million to hackers. But the issue is much larger. JBS SA is a company where a lot of ex-employees say that the company's utter unwillingness to keep up its cyber security and not much they do on that is the responsible factor and is the reason why this has happened. Of course, the company would officially deny that, but we have to look at the role which independent news collection would play. Because officially, many of these companies would not admit in official reports, which are either an ESG report or sustainability reports, you will not find this information. You will not find this data, but you have to look at the independent reports, you have to look at the independent news flow to ascertain what's really going on. There are also other reasons, be it deforestation of Amazon rainforest or insider trading allegations or the nexus between the promoters and the politicians in Brazil. It has been in news for many of the wrong reasons, and that's something which is a very important role it plays for the institutional investors' decision on how they would look at this company. Then again, a company which got caught in the political risk, and that's something which is very, very important. So when you look at, again, maybe an example which would probably resonate a little more with the audience, it's very, very similar to what happened in the case of Alibaba and the Chinese government stand had taken last year on the IP of andcorporations. And that is something which is purely a factor related with the political risk that's a part of the governance or the broader ESG framework. And in this case, it's a company which is one of the leading companies in Egypt, almost 35 years, 40 years old, and an example of great entrepreneurship by an individual. And if you go a little deeper, you find that they were doing broadly fine even after the revolution which happened in Egypt. But around 4 to 5 years ago, they had a problem in terms of how they are being perceived by the government. And this is, of course, as an investor, you would not be able to take sides because you really don't know what's the reality or what's the truth. But for investments, it's very, very important to not ignore that risk. Political risk is something which is so important that it could lead to 20%, 30%, or 40% kind of corrections in your investments stock price. And that's something which you really need to focus on if you have to take care of the ESG risk which you carry in their portfolio which you have. Then this is the last one, Saudi Aramco. Again, trillion dollar market cap company. Almost 70 to 80% of Saudi economy dependent on this company and the revenues it generates. But not that much focus on ESG. Again, it's an oil company, so you would see that the environmental part is extremely important to them. But what they had done is, in terms of the focus which many of these companies would have, they would put very strong reporting about the social issues, about the initiatives for the community, but not that much on what they're doing about environment. And in this case, there was also a problem in terms of how they were reporting. So there were reports about 5 months ago that the emissions which they were reporting, like, of course, I will not go into that much detail what scope 1 is, scope 2 or scope 3 is, but the bottom line is that the company was excluding at least 50% of the emissions because the facilities of the refineries of the plants which they have were outside Saudi Arabia. And that's not right, because as a company, you need to report everything which you are responsible for. And otherwise, what will happen that will look better than what you where you actually stand and what you actually are. So broadly speaking, I think these are some of the issues which are relevant in the space which we have, the emerging markets. I've tried to use more examples to understand these issues and explain them. And that's something which, if anybody has questions, people may again ask on them. What are the key messages here? Information access is extremely time intensive and cost intensive process for investors in EMs. In emerging markets, especially, people struggle with that. Language, in many cases, is a big barrier. Like if you look at a country like Brazil, if you look at a country like Korea, China, Vietnam, Indonesia, Poland, you would need to have something which can capture that. As I said, like 80% of the information is in local news. And that is very, very important for a rational, prudent investment decision making. How to address these issues? You need real-time collection in multiple languages, instantaneous machine translation, and analysis. On the basis of that, you can draw inferences and you have actionable inputs. You have actionable recommendations, which you can use to take investment decisions. Then there is a need for investors to report responsible behavior of companies on ESG and penalize the companies which are not doing that well. And that you see a lot more often, like just a couple of days ago, Harvard University deciding that they're not going to invest anymore in the oil and gas businesses. I've not included those examples because they're not that relevant for investors in emerging markets as such. But these are very global issues and we need to take care of that. And ESG, as everybody has said, that is gaining so much traction, gaining popularity for investment decisions. And you need to have a framework which is the right framework for you. So there are multiple frameworks available. There are multiple options for you, but you need to look at what is right for you. And this flexibility which you need to deal with these multiple frameworks is very, very important factor in how your investment decision quality would look like. And in this case, the better option is to look at E, S, and G, and even more granular categories in a bit more detail so that you can take prudent decisions, you can take right investment choices. Thank you very much. That's what I had. Thanks again for the opportunity. ICC, Paul, Swarish, and Smita, thank you very much. Thanks a lot.
Thank you, Pankaj, for that very interesting presentation and all those examples. It was really insightful. I think now let's move on to the Q&A session. So before we get into audience questions, I thought let's discuss some aspects on ESG. So until recently, ESG has been a very rich world phenomenon, right? So even in developed countries, up until 4 or 5 years back, many would have thought it to be a vague concept, as its linkages with investments and finance were not really well established. But with rising global investor focus and pressure of international investors, there's an increased buzz on ESG. So how do you see this trend panning out in emerging economies?
See, I think that's a brilliant question, Smita. I would say that the measure of this is that if you see the people or the skeptics, that number is declining. So 3 years ago, probably you would see that if you do a survey, 5 out of 10 investment managers would say that ESG is not going to be useful, is just a fad, is something which will not be relevant for them. But that number would not be more than 20%, 30% today. There is still a sizable quantity. I'm not saying that that part is completely taken care of, but the way a lot of people have started to react now, that they have realized that this is not going to go away, because many of these issues are relevant for how the companies are being run. And it's not just a case with the markets which are developed markets or the regulators which are there in those markets. So for example, like when SEBI, the local Indian regulator, says that from next year, you need to have the top 1,000 market cap companies in India, they need to report on many of these issues. Like there is a 40-page PDF you have to refer to what kind of reporting SEBI would expect. But these are the developments which mean that you have a situation in emerging markets where both regulators have and the investors have realized that for their investment decision making and to make the destination more attractive for a regulator or for a government, that is also a priority. These issues cannot be ignored, and it's happening across the world. Even you would be surprised. A lot of people would be surprised. I would say that the kind of emphasis, even the smaller economies like Oman, Saudi Arabia, Korea, of course, Korea is not small, but when you look at some of these issues which we have had in that country, the kind of emphasis which is being put on ESG issues, it has qualitatively changed. And once that acceptance is there, people realize that it's not going to go away. So emerging markets are going to see, probably they have to play a little bit of catch up with developed markets, I agree. But since this is a concept that has been accepted by everyone, it is going to be more and more relevant for the EMs in near future.
Right. So interesting to hear this perspective, especially about the regulatory aspect which you were telling. So in fact, Optus ESG had curated a webinar in May 2021 around ESG and climate risks in Asia and Africa. This was with 2 industry associations of DFIs in Asia, Pacific and Africa. And what came out of that was that non-financial reporting that had emerged as a critical factor in the course of our discussions. So which actually brings me to the next question on ESG and reporting. You had briefly mentioned it also. So ESG and climate related reporting is fast becoming a mandatory requirement in the developed world. But in the developing and emerging economies, ESG performance has suffered. It's not just because of low adoption and awareness, but also because of limited ESG regulations and reporting. So how do you anticipate the changing scenario of ESG disclosures and reporting in emerging economies? And more importantly, how can the risk of greenwashing be minimized? So you had mentioned in your presentation about this Saudi Aramco, right? So that is one kind of greenwashing. So how do you think the regulator can play a role in this?
I think that's again a very interesting question. I would say that a lot of this is related to what the official stand would look like. So again, this is an example from US, but you can see that the way SEC was treating many of these issues related with ESG before Biden got elected, and how they're treating them now, there is a massive difference, a huge gap between the approach SEC had earlier and SEC has now. This is very much relevant for emerging markets as well. So, for example, let's say when you have the COP26 in November in Glasgow, the stand which countries like China, India, Russia, Brazil, many of these countries, the stand they take on climate-related issues, the targets they would agree to, the commitment they want from developed countries, all that would be very very much related and linked to what the regulator locally would decide and the reporting standards they would expect. Because you cannot have a situation where the government and regulator are not on the same page. What the Indian government would expect or Chinese government would expect from regulator, or they would expect in turn from the companies, is very much related to what the broader thinking on many of these issues is. But yes, in terms of what they want the companies to report, in terms of the data disclosure, so let's say if you have a situation in Saudi Aramco where the emissions are not fully captured, or many of these oil companies are not even willing to consider the possibility of reporting on scope 3 emissions. But in many cases, the shareholders are pushing them to do that. Like it happened in the case of Chevron. But in case of regulators, they have to also look at that what is that which is going to be a balanced approach in terms of not too much expensive, too much burden on the companies across the different across the spectrum in terms of size and the cost which they have to incur. So, for example, like somebody like Reliance is a $200 billion market company can afford a lot of this reporting, but somebody who is not that big, the regulator has to take an approach which is pragmatic, what is possible and what is not possible. So I think that's something which will play an important role. But yes, I think the way it looks like that we would have more and more stringent regulation, and regulator would expect that you need to report more. Formally or informally, that dependent on the regulator's approach and how they decide with consultation with government or the authority. But I think this is going to be very important.
Absolutely. So I think, so yeah, regulatory proactiveness is an important step to promote investments in emerging economies. So one of the engagements which Octus did again was to, they are currently working on is, we are working with a UK government-backed project on strengthening climate risk assessment and enabling central bank supervision in the Indian financial sector. So this involves like designing modules on how to integrate ESG risks and climate risks as a part of credit assessment processes in banks. So what, in your opinion, actually will encourage banks and investors to incorporate ESG aspects in their lending and investing decisions? I know that this has started and it is picking up fast, but what will actually help them, speed in the whole process of integrating these aspects?
I think you need a little bit of push from, again, as for example, central bank would play a very important role. So that's what we discussed in the case of ICBC also, and what's happening in a lot of insurance companies. We talk to a lot of banks in Southeast Asia and in other geographies. What we find that banks are looking at this on two sides. One is that they know that in terms of their credit, in terms of their lending, they have to ensure that they are not lending to people who are very troublesome. So in terms of, not in terms of repayment, but in terms of ESG track record, that's something which is very important for them. And also in terms of what is expected from them on how the responsibility or the onus would be in terms of what would capture the impact they would be making. So for example, if you're funding a coal-based plant, which is going to be a strong emitter, if a bank is going to be penalized in terms of their scope 3 emissions, then definitely it will be a very strong disincentive for them to stop that funding and look at what could be the alternatives and what funding you can do. And also in terms of what is the broader ecosystem is thinking about, for example, like the pickup in green bonds, the pickup in many renewable related technologies and the projects. And like just last month, we analyzed a lot the company in Denmark called Ørsted. It was a company which was named as Long Energy. It was an oil and gas company since 1973. But 10 years ago, they decided that they are not going to do it anymore. And that's something which played a very important role in them evolving as a major player in offshore wind. It's one of the largest energy companies in the Europe or EU and largest in Denmark. And the transformation journey is fascinating. At the same time, they had very strong backing from the local lenders and the financial institutions who supported them in that initiative. So like you need lenders who can support these initiatives, and at the same time, they have vested interest in that, because if they get more proactive on ESG, they would definitely be evaluated more favorably by the investors and the people who would be giving them money. So I think that's it's an approach which requires a little bit of balance, and also it has to be linked with what's happening in the broader ecosystem and how the space is evolving in terms of their major priority lending areas.
Very true. Yes, sure. Sure. So next, I actually want to delve a little bit into what technology can do in the context of ESG. So you had in your presentation spoken about how AI, artificial intelligence, and machine learning can help in addressing the risks in terms of your services. So I wanted to understand your thoughts on how technology can help in tapping ESG related opportunities. Like, for example, the use of new technologies to reduce GHG emissions. So we've seen the risk part. So what about the opportunities in emerging economies?
It's fantastic. I think that's where imagine a situation where you have to do so much of data disclosure, so much of reporting, and at each and every step you have to look at what automation you can bring, what the usage of technology you can bring in your processes, and it's applicable at each and every step. So when you talk about a company, so we have spoken to a lot of asset managers, and many of them say that they know that for them it's very, very important to look at what a framework can do for them, but they are not prepared in terms of they really don't know how to evaluate that using best possible technology and very efficient way. So let's say somebody as an asset manager who has 150 companies in his portfolio or her portfolio, the person would not be able to do it one by one. Like you need to have a solution which can give you insights in 5 minutes or 10 minutes maximum. How does your portfolio look like? And if you remove these 5 companies or reduce their weight or increase the weights of other 5 companies, how the impact would be on your temperature scenario. So for example, like today you are at 2.2 degrees, but what the change would do? Like would it come to 2.4 or would it become 2.1? So that's something where the technology is playing a very important role. And we have seen a lot of cases in asset managers we work with. These people are very, very open to ideas in terms of how the ESG performance evaluation can help them in making their investment management better, and also to identify opportunities. So we have just last week we were speaking to a guy who is not even, I would say, $1 billion market AUM, but I was very much interested in what's happening in China in ESG opportunities, what's going on in some of the other emerging markets in terms of how the ESG data can help him in making stock calls which are better, qualitatively better, quantitatively better, and give them that edge which is needed. So I'm saying that in terms of companies, in terms of asset managers, in terms of regulators, everywhere you will see a lot of technology can help in identifying the problem areas and offering solutions. But definitely for companies in data capture, for somebody, let's say 50 plants, 200 locations, how to do that without technology is just not possible. I'm just talking about even basic aspect of electricity consumption for a plant which is, let's say, consuming in different areas, and then how to tabulate the renewable consumption, how to tabulate the grid consumption, and how to look at this exercise for 300 locations, 500 locations. It's not definitely going to happen without the use of technology. So everywhere, like, of course, specific cases might be different. I would say for companies as well as asset managers, I think there is great opportunity to use technology and talk to people who can help them in doing this reporting and disclosure better.
Sure. Yeah, I think it is really exciting to think of the opportunities which can be tapped into with the help of technology. But I think, access to finance is extremely crucial to manage ESG risks as well as to tap opportunities. So in this context, innovative models of financing becomes very important, right? So for example, Optus ESG is currently working on designing a climate finance facility in the renewable energy sector in a sub-Saharan African country. So we need more of such models. So how can investors from developed world contribute to the success of mobilizing such sustainable finance activities for ESG?
Wow, I think that's an area which is very close to me, because as I said, like because of the background which I have, in terms of what you see that, for example, look at EU taxonomy regulation. The investment a fund manager who is based in EU and the person will make in that geography is not sufficient. They have to look at the investment they are making across the world. So let's say if an investment manager or a fund is making some investment in Africa or in Asia or in any other geography in Latin America, the EU taxonomy regulation would want that the evaluation has to be done in a way that ESG parameters are taken care of. Your investments are ESG compliant. And that's something which is now going to be very, very important in terms of how you can push many of these technologies which are important in bringing many of these geographies up to the speed. So even today, you would say that, okay, developed countries are polluting more. It's fine. But when you look at the potential in terms of how the consumption is growing in countries like China, India, and many African countries, Latin American countries, you have to think about a scenario 20 years later. And in that case, if you start investing today in technologies, in options which are more green, which are better ESG compliant, that is something which is a role developed market investors can play very, very well. So it might happen because of the regulation change in their own jurisdiction. But at the same time, if they take a proactive approach and see that, okay, what's going on in a country like Brazil? Imagine the country saying that they will continue to burn coal till 2050. And if investors push and find a solution which is more acceptable to the government and to the authorities, and based on renewables, it has massive opportunity in hydro. So those kind of investments, those kind of fund flows, and through other investment vehicles also, like you have, as I said, like in India, the kind of green bonds funding which is happening today, and the money raised is shooting through the roof, and it's happening across the board. It's not just the case with some geographies or maybe particularly one or two countries. It's happening across the board. The kind of money which you are able to raise for better technologies in climate, better technology in terms of your ESG parameters, I think that's going to be a very important role developed market investors and fund providers can play.
Right. So I would actually next like to talk about the social aspects, the S of the ESG. So despite the importance of social factors, because they are qualitative in nature, usually they get pushed back to the back burner, compared to environmental factors because of the qualitative nature. So how do you see this in the context of emerging economies where S is all the more relevant?
I think I would have a slightly different opinion. I think most of the companies, it's such a very, there is a lot of text you can put in what you're doing in CSR and what you're doing in your social initiatives in ESG. And a lot of times you would see, I think we have done a lot of analysis on how the sustainability reports look like. So even the big companies like Alibaba and many of the companies which you find from emerging markets, there is a disproportionate amount of coverage on social issues. It would not be data. I'm not saying that there is data on that, but a lot of it is related with what the companies are doing for community, what the companies are doing for the society, for the employee welfare and all that. It's fine. But the point is that till the time you actually give more disclosure in terms of data, in terms of hard fact, filling pages with nice pictures and filling pages with nice text is not going to help. So what I'm saying is the social part is something which is a case of very solid greenwashing in a different way. So greenwashing is a term which is probably, you can just say that, okay, what you're doing for climate and how you're reporting.
It's social washing.
Social washing, like whatever you call it, CSR washing or whatever. But point is that thing is, at least in my opinion and of the analysis, what we have done in last 3 years using the AIML tech which we had, I think it's a very important concern area that companies should probably disclose better on social part. Companies should disclose more on social part, but more importantly, they should disclose better. They should disclose more data. They should disclose more hard facts on what's going on.
Right. Wonderful. Thank you, Pankaj. I think now we'll move on to audience questions. There are a couple of one or two questions. So Sriram Singh has asked, so there is a lot of talk on ESG funds coming to India for investments, but on the ground, they don't seem to be very active. For example, we are looking at raising funds for more eco-friendly bio-CNG plants in India on kitchen or vegetable waste, rather than incineration-based estate to energy projects are getting funded. So how can the team help, he asks.
So again, I think you have to also help Smita in answering that question. But
Sure.
I would say that for investors which are coming especially from abroad, for them it's very difficult to pick a particular region or particular aspect of renewable. They would be focused a lot more in what's happening in the space which is more organized. So for example, let's say if they want to take an exposure, they would probably look at options like, for example, listing of Renew Power, which happened last month, or maybe option like what NTPC is doing in the renewable portfolio, or what Adani Green is doing in their expansion. So I think that's something which is more applicable for foreign investors. Locally, I think what you would have to look at is that what kind of support and what kind of ecosystem you have for these technologies in terms of the local support from the state government to the central government, and also the people who would be looking at investments from that angle. So for example, Avishkar Fund, or a lot of these initiatives which people have in making impact investing as their focus area. These are the kind of people who would be probably more interested in these opportunities. But as such, for someone who is a little more organized and the scale which they need, I think practically also you have to look at it. Somebody is thinking of investing a few $1 billion. For them, small investments will really not going to move the needle. They would have to look at what is a sizable investment they can make in a particular technology or a particular region. So that's something which is going to be important.
Absolutely, I think I agree with you 100% on that, and that is the answer. So it's also because there is more transparency, disclosures, all that come into play when funding a larger company which is more organized. And whereas a smaller company like a kitchen-based initiative like what they've told will be more suitable for probably to start off with a grant-based model and then scale up further from impact funds, debt and equity impact funds, and then look at a larger investor coming in from abroad. Just to add on to what Pankaj has told. So I think that is the question. There is one more question from Ayushi. She says, when speaking of Africa, ESG is pretty much a new concept that is now being accepted. What are the possible barriers to sustainable investment in the African continent?
I think this is, again, very relevant because in next, let's say 50 years, Africa is going to play a very important role. Maybe like the way we talk about Asia in first 20 years of this 21st century, I think the same thing will happen 30 years down the line. 2050 to 2070, you will talk about Africa in the same way. I think what probably need to happen in Africa in that sense is that a lot of people we speak with, they are a little bit worried about the reliability of data, the reliability of information, and the local structure on the governance part. So I think these are the problems which a lot of investors highlight. These are the issues which a lot of people talk about, that there is lack of reliable data in terms of what they can do in that geography, and also in terms of not everywhere the governance is a problem, but in a lot of cases they are also concerned about that. So I think if these 2 or 3 problems can be solved in a better way, and I'm pretty hopeful and optimistic about that this will happen, and the future looks very bright in that sense. But immediate priority is that if we can take care of 2 or 3 problems, I think investors definitely would show more inclination to come and invest there.
Absolutely, sure. So we have one last question from the audience. Ranjan Sharma asks, is ESG theme equally relevant to retail investors?
Oh wow! I think that's something which you. I would say that I am referring to a survey which IBM carried out in March, April, And what they did, that they asked questions to the consumers, their employees, and basically the retail segment. And the questions were related with the kind of focus which people would have. So imagine a situation where today, for example, the IPCC report which came last month, and Code Red, as the UN Secretary General explained it, those kind of things would not have grabbed attention which they're grabbing now. The responsibility of a retail investor or retail customer, imagine, like, you would not have seen this kind of social media backlash in many of these cases which you would see. For example, like China, South Korea, even in India, like the example of Zomato commercials in which people were like, there was so much of media backlash against what they are portraying as their delivery agents would do when they meet Bollywood stars. And those kind of things are very relevant for retail customers and retail people. These issues are getting more and more prominent, and people who want to make responsible choices, they are ready to pay even little more. So we carried out a study in the month of April to June, the second quarter of this year, where we interacted with almost 300 customers who shop online. So primarily the customers of Amazon and Flipkart. And almost 80% of the people are aware about the responsibility which they have in the ESG space, in the sense that they have to make more responsible choices. And you would be amazed to know that almost 50% of them are saying that they are ready to pay at least 5 to 10% more for a product or a service that is not harming the environment, that is not using child labor, that is not harming the broader community. So I am saying that the responsible investor or responsible customer is ultimately going to decide the fate of ESG. You cannot have a situation where there is a disconnect between what the company is doing and what the customers are thinking. If the customers force that you have to behave, you have to be more responsible on ESG, then the companies will not really have a choice. So more awareness, more responsible choices by retail customers, definitely it's a very, very important role in ESG space going forward.
Sure, great. So I think that brings us to the end of the questions. Thanks so much, Pankaj. It was wonderful interacting with you and
thank you, Smita. Thanks a lot.
Yeah, I also like to thank Paul and the entire ICC team for inviting me to moderate. Over to you, Paul.
Well, thank you very much to Smita and Pankaj for such a very insightful discussion. I think if all of us were following keenly, then we know that this has been very informative. And so for us at the ICC, what we're going to do is that we have a recording of this webinar. We are going to make it available via YouTube channel. And of course, we will send via email to all participants that are registered and partook in today's webinar. So we are very grateful for this opportunity. Also, as I did mention earlier, we have series of these conversations that are coming up. So our next event is on foreign direct investment, which is on the 23rd of September 2021. After that, we have one webinar on the African Continental Free Trade Area. So that is region specific. So all those who are looking at the African continent and how the continent is integrating and having a common market called the Africa Continental Free Trade Area, you would like to join us on September 30th for this webinar. And all of these webinars are available on the Institute website, www.charteredeconomist.org. There you can find access to all these events, and they're absolutely free. You just have to sign up so that we can keep reminding you when it's getting closer. So thank you very much. On behalf of the ICC, a big thank you to Smita Hari, who is the Vice President, Sustainable Finance and ESG at Altus ESG, and our main speaker, Pankaj Sharma, who is a co-founder and partner at EM Alpha. We say a very big thank you for being a part of today's discussion, and we'll come your way soon in terms of future events. Thank you very much, and enjoy the rest of your day.
Thank you. Bye-bye.
Thank you. Bye, everyone. Thank you.